The broadcast is now starting. All attendees are in listen-only mode.
Good evening, everybody. I want to do a really quick mic check. If you can hear me, can you just put a Y or a yes in the GoToWebinar question tab? We'll be getting started here in just a moment. Good evening. All right, thank you. Okay, we'll be kicking things off here in just a couple minutes, so bear with me. Alrighty, I want to welcome everybody. Thank you for coming to tonight's webinar. My name is Thomas Wood. Tonight we're going to be talking about Confluence in trading, which is essentially just combining multiple strategies into one to make a more effective or more selective strategy depending on the type of trading you like doing. Now, it is a pretty simple concept, so tonight's webinar will be a little bit shorter than usual. We'll probably only run about 30 minutes long, which is fine. If you have any questions, though, feel free to ask them at any time via the GoToWebinar side menu, and I'll try to answer them throughout the presentation, and then again at the end we'll do a quick Q&A. Now, before we really get started, really quick, just general risk disclaimer. Trading or investing carries a high level of risk and it's not suitable for all persons. Before deciding to trade or invest, you should carefully consider your investment objectives, level of experience, and ability to tolerate risk. This content is subject to change at any time without notice and is provided for the sole purpose of education and assistance in making independent investment decisions. ValueCharts.com has taken reasonable measures to ensure the accuracy of the information contained herein. However, ValueCharts.com does not guarantee its accuracy and is not liable for any loss or damage which may result directly or indirectly from such content or from an inability to access such information or any delay in or failure of the transmission or the receipt of any instruction or notification in connection therewith. Any past performance results are shown for illustration and example only, are hypothetical, and as such have many inherent limitations. No representation is being made that any account will or is likely to achieve profits or losses similar to those shown. Past performance is not necessarily indicative of future results. Then along those same lines, we're required to show you CFTC Rule 4.41. Just a general hypothetical disclaimer. Obviously, everything we're showing you, chart examples and things, are from the past. So hindsight's 2020. It's really easy to say you could have done this and it would have worked. Now that being said, I trade these strategies myself on a daily basis. I know Mark does and many other people do. So we believe they work very strongly. But again, hypothetical disclaimer, hindsight's 2020, basically. If you want a copy of any of those disclaimers, just send an email into support@microquant.com. We'd be happy to get you a copy of those so you can read them in full if you would like. So now to go ahead and kick things off, what exactly is Confluence in trading? Confluence in trading is combining two or more strategies into a single strategy. It's used a lot of times, or the word confluence is really designed from when two rivers come together and form one river. So basically, same concept, taking two strategies, bringing them together, making one strategy that combines both of them, taking pieces and parts from both. Now, why is this important to your trading? Why does this help you? Because depending on the type of trader you are, some traders like being more risk averse. Many traders like using Fibonacci's. Many traders like using value levels. Many traders like using divergences or candlestick reversals. Well, if you take all of these, what you can do is essentially design a strategy that implements the best parts of each one and allows you to be more selective with your trades and in turn, hopefully, increase the probability of your success rate with your trades so that you are more successful more often. Now, there are a couple of risks with doing this, and the the main one is just if you have too many strategies combined at once, you run the risk of never really being able to trade. If you're being so selective that so many different parameters per se have to be met in order for you to actually take a trade, then you may only get one trade a year or one trade a month. And some traders may be okay with that. Other traders say, no, that's not enough at all. So just be aware of that. Be careful when you're putting together these strategies. You want basically the way that we trade here and the way that we teach here at Microquant is probabilities trading. So you're looking to trade. With every trade you want to have the odds in your favor. So you're trading essentially like you're the house of a casino, where you have the odds of winning in your favor. Now, that doesn't mean you win all the time, but it means that if you take it out and track it over a larger time span or a longer amount of time, larger number of trades, you end up coming out on top because the odds are in your favor. You have a 60 or 70 or 80% chance of being successful. Now, I'll show you a little bit later some of my favorite strategies that I combine using Confluence and trading to put them together for my actual entries. But along the same lines, this is one thing that I believe is very important to any trader out there. And you need to be looking at this in a way that you're analyzing, okay, the way that I personally trade is I'm very risk averse, or I like having 50 trades in a day, or I like only having 5 trades in a day, but I want those 5 to be at least 90% of the time successful. You can do that. You can make a strategy essentially that allows you to trade as much or as little as you want, depending on your personal trading style, as long as you know what you want, if that makes sense. So you need to be looking at it. You need to say, okay, I want to be trading 50 trades a day. I want to see at least 50 trades a day. Well, then you may not want to have too restrictive of guidelines for a trade setup. If you only want to have a 90% success rate, you may want to have very strict guidelines. So keep that in mind whenever you're looking at the strategies you're going to use, that you're going to combine and then trading them. Now, that being said as well, you also want to make sure that the strategies you're using are combining together complement each other. So you don't necessarily want to be taking a bullish divergence on a breakout. Well, if you're trading a breakout on a trend line, but there's a bullish divergence, those are one saying it's going to go up, the other saying it's going to go down. You don't want to be obviously combining two different strategies that are going to not really support each other. So make sure that when you're sitting here going through your trading catalog or your toolbox, looking at the strategies that you use to trade the markets, make sure that the ones that you're using to combine to make a new strategy that's more selective, make sure that they actually complement and work with each other. Now, a couple examples of this. These are some strategies that I personally use in my trading. The first one is value candlestick reversals, second one is divergences, and the third one is trend lines. Okay, so if you're in the futures trading room or even in the options or forex trading room, I know that Nate and Dave both use all three of these strategies themselves. We use value candlestick reversals, which honestly, this was created by using Confluence because what we did is we took candlestick reversal patterns, we added two different filters from two different strategies. We added an 8 EMA filter, and then we also added a value-based filter based on value charts to come up with the value candlestick reversals. So this strategy in and of itself is really combining three different strategies together to make one more successful strategy to increase the odds, the probability of those candlestick reversals coming true. We also trade divergences, and if you think about the way we trade divergences in the trading rooms, we actually use Confluence in trading for the divergences that we trade as well. We're not only trading the momentum divergences, but we're also adding a filter of, okay, if we're going to get short, we need it to be overvalued, or if we're going to get long, we need it to be undervalued. Trend lines, they're basically just themselves. We're not really combining multiple strategies for trend lines. That's just trend line. Now, in order to take a short trade, here's a couple examples of how you can combine the three up here into different strategies, into one strategy basically. So you're limiting yourself. I want to make sure I want to be more selective with my trades. So I'm going to say, okay, in order to take a short trade, The market not only needs to have a bearish divergence, it also needs to be a candlestick reversal, um, and it needs to be in a value level. So you're looking at a value candlestick plus a divergence equals the new strategy. So you're looking for divergences with candlesticks to identify the exact top. Now that's going to be more selective. They're not going to happen as often, but when they do occur, you're going to have a higher probability of having a successful trade, which is the entire goal of Confluence in trading, making the probabilities of your trading higher, or increasing the probabilities of a successful trade. Here's another example. In order to go long, I want to have a bullish divergence on top of a trend line or on top of a support or resistance level. So you not only want to have a divergence, a bullish or bearish divergence, you want it to be sitting on top of support, plus you want it to be undervalued. Now, we here at MicroQuant, we typically, for every single trade we take, just about, not 100% of them, because we have momentum inflections that we use that don't really take value. We also trade breakouts that don't consider value. But with almost every single other strategy that we employ here, we use value on top of it. Okay, so we take value charts and we say, okay, the market, if we're trying to go long, we want to limit ourselves to going long only from undervalued. And that's basically Confluence and trading in a nutshell. We're taking whatever other strategy we're using to get in that market long, and we're saying, okay, in order for us to actually use that strategy, it has to be in the appropriate value level. The reason we do that is obviously the probabilities of it. We know that if a market's undervalued, statistically speaking, we have a higher probability of it going up sooner or before it comes back down, if it's going to go back down further. So it's all about odds. It's all about probabilities. Just like if we're trying to go short, no matter what strategy we're using, whether it be divergences, trend line, candlestick reversal, we want it to be overvalued if we're going short, because then we know that statistically speaking, the probabilities are in our favor for that market to actually fall. Does that make sense? It's pretty simple concept, I believe, but I want to make sure everybody understands how Confluence works. In order to go short, you want to have a bearish divergence plus a candlestick reversal, then you wait for the candle to close. For any candlestick reversal pattern, you're waiting for the candle to close. Okay, you're never taking a candlestick reversal while it's open, because that candle could go from looking like a shooting star to not being a shooting star at all, or from looking like a doji to just being a very bullish candle or a very bearish candle. So with any candlestick reversal pattern, you're waiting for the bar to close. All right, let's go ahead and take a look at just a couple chart examples that are pretty simple, but that show essentially some Confluence in trading, how you can combine multiple strategies to make one strategy and increase your probabilities of success. Okay, so here's an example of a red hat shooting star on top of a trend line. Remember, we were talking about combining trend lines with a value candlestick reversal. Well, right up here, you can see right there is an excellent red hat shooting star. I mean, that's just textbook candle, pulled away from the 8 EMA, significantly overvalued upper wick, right on top of this trend line going across those bars highs. Okay, so what you've done here is you've taken a value candlestick reversal pattern and you paired it with a trend line. So you have a very good short signal with a much higher probability than if you just had a value candlestick reversal pattern by itself. So each tier, basically, each additional strategy you're adding is increasing the probabilities of success by a certain amount. Now, keep in mind, if you put too many tiers on there, if you put too many strategies, you're saying it needs to meet this criteria and this and this and this, you're not ever going to find trades. So you have to walk the line between too many and not enough, because if you don't have enough requirements to get into a trade, then you're going to end up with a lot of really poor trades with a very low success rate. Another trade that's on the screen actually is a bullish value divergence right here on the low end of this candle, where this market dipped all the way down here. You look at the value chart, you can see here you had a bullish divergence on the value chart where you had higher value levels even though prices were lower, and then you also pair that with this support level that's coming across from that previous low right back here. So you came right down to a support level, plus you had a bullish value divergence, all adds up to be a higher probability entry for a long position. Okay, so you can combine these things to increase the odds of a successful trade. Are value candlesticks different than regular candles? All a value candlestick is the difference between a value candlestick and a normal candle. So for example, the difference between a red hat shooting star and a shooting star candle is we add several different filters. We've put in value-based filters, so it has to meet a specific value requirement. We've added a distance filter between how far it is away from the gravity line. We've also added filters based on the positioning of the previous bar. So for value candlesticks, it's essentially just a normal candlestick that we've taken several other strategies, combined them together to make a single strategy that we call value candlesticks, and it increases the probabilities of success. When you wait for the candle to be closed, the market may have run away. If you're trading candlestick reversals, the market's not going to have run away. The way the candlestick reversal works is you're identifying when a market's getting ready to run. So you're catching that middle 80%. So you might have lost or missed out on this portion of the move, that upper wick, but you're in it right there at the open of that bar and catching those 3 candles down. So not necessarily, even with a divergence, not necessarily, because if you're pairing a candlestick reversal with a divergence and that candlestick reversal is going to play out, then the next several candles should be down or up candles in the direction of the divergence. You don't want to be looking at a short somehow you don't want to be looking at something that's like a bullish divergence with a bearish candle, because that wouldn't make sense. When I was talking about how you don't want to combine strategies that don't complement each other, that's what I'm talking about. You don't want to have a candlestick reversal in one direction and a divergence in the other direction somehow, which if you have that, you probably are not reading your candles correctly. But you don't want to have something like that where they're disagreeing, because that is just going to sow confusion and not help you at all with your trading. And again, with a divergence, if you're adding the divergence in with the candlestick reversal, then you should see prices move in your direction for the next several candles. So it all depends really on the time frame you're trading on. If you're trading a candlestick reversal on a 5-minute chart paired with a 5-minute bearish divergence, then over the next 10 to 15 minutes, you would expect prices to be down in the direction of that bearish divergence. Whereas if you're trading a bullish divergence with a bullish candle, so a red-handled hammer or something, on a 60-minute chart, then over the next 2 to 3 hours, you expect prices to be up. So keep in mind, it's based on the time frame you're trading. It doesn't matter what time frame you trade. You can trade whatever time frame you want. Just make sure your profit targets, stop levels, and everything are set according to the time frame you're trading on. So let's take a look at another example of Confluence in trading. Here's one. This is another value candlestick reversal pattern. So we have a yellow jacket doji paired with the MQ regression for a trend. So we've taken MQ regression, which is this red line coming down. You can see right back here where it turned from green to red. So green means uptrend, red means downtrend. This is saying, okay, it's in a downtrend, and what we've done is we paired it with a value candlestick reversal pattern to find entry. So we're saying, all right, we not only want to have a value candlestick reversal pattern, we want to have it with a in the direction of the trend. And you could actually have also looked here and said, okay, I also want a value bearish value divergence, because you have a lower high here than you had back here on your value chart. So you had a bearish divergence. Even though you had higher prices, you had a lower value level, paired with the yellow jacket doji, paired with the trend being down, all gives you combined a great entry short to catch the rest of this down move. Now, you also had another entry here that you could have been using if you're trading in the direction of the trend. This still was not a bad short opportunity right there. That's still a yellow hat doji. Regression was down. It met the full criteria to be a short, or a yellow hat doji be a value candlestick to the downside. You still dropped off just like you expected. You would have gotten stopped out break even on that trade though, because you hit your first break even stop target. Okay, so does that make sense? Pretty simple. You're just combining several different strategies that complement each other into a single strategy that increases your probabilities. Another way you can do this is, for those of you that have the value charts or the MQ indicators, for if you have the large bundle, you can use the MQ trend. And one of my favorite ways to trade trend following is with the MQ trend and the MQ regression. What the MQ trend would be doing is it would have red dots coming down, okay? And they would have been something like this, coming down, 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 like that. And as long as the MQ trend and the MQ regression agree on the direction, so you're adding two trend filters, then you have the okay to go short at the value-based entry. So if both MQ trend and MQ regression are red, then you'd be going short on the overvalued bounces there, here, here. So you have a couple different filters that complement each other, which is both the MQ trend and the MQ regression. They're both trend indicators. They both are looking at different aspects of price movement, so it can help filter out some bad trades by helping you stay out of markets that are not really trending or that are getting kind of into a choppiness. The reason I like those two indicators combined is because what it does, the MQ regression will be a little bit more reactive than the MQ trend will. The MQ trend will kind of filter out some of the noise, but the MQ regression, what that will do is it'll adjust a little bit sooner. So if they're not in aggression, you could say, okay, we're getting into a choppy state in the market where it's not trending as well, so it's better just to leave it alone. Those are two indicators that work very well for Confluence. What do you do when MQ trend is conflicting with the MQ regression? No trade? That's correct. If the MQ trend and the MQ regression do not agree on the direction, then I will not take the trade. That's why the Confluence works so well, is because it'll filter out bad trades. A lot of times if the market starts getting, it was going down pretty steadily like this, but then the market starts getting choppy like that, the MQ trend may still say it's in a downtrend, but your MQ regression will have gone from downtrend to an uptrend. So if this is in an uptrend and this is in a downtrend, they're not agreeing on the direction. So you don't take any of these trades because the market's just choppy, period. Once they start agreeing again, when the market starts moving back down or reverse, both moving back up, then you start trading in that direction again. Here's another example of combining a couple different strategies. Now this is combining value candles once again. This is with a yellow tip doji right on top of a support level. This is RBOB on a daily chart, and you can see here you had a very nice yellow tip doji right there, paired with this support coming across from these previous lows here. So not only do you have a candlestick reversal saying the market should go up, you also have a support level sitting right below it saying, hey, prices should not dip below this level, which gives you the okay to go long. You can see just what happened there with RBOB. It just went through the roof. That was a couple weeks ago, how that happened. So pay attention to this sort of thing. This is another way you could have been filtering out your trade entries. You can also see up here we had a nice yellow jacket doji all the way up at the top, right up there. And yeah, that's a terrible arrow, but I'm sorry, really bad at drawing with my mouse apparently. You had a yellow jacket doji all the way up at the top, and you had a textbook bearish divergence saying prices should go lower, where you had higher prices here, candlestick reversal, paired with lower indicator, lower high on the indicator, so very large weakening of momentum. You see what happened there. I mean, that ended up being an entire very large sell-off in RBOB. The other thing you could have been looking at is a trend line coming down across these highs, just like so. And you can see here you jumped all the way up, you hit the trend line, so you had resistance there, plus right at the top of that bar you went overvalued. So you not only had a trend line saying there's resistance, prices shouldn't go higher, you also had an overvalued price saying, hey, the probabilities are, the odds are in your favor that prices are going to go lower before they go higher. You see what happened there? Prices sold straight down very, very quickly. So there's a lot of different ways you can combine strategies. This is really pretty simple topic, like I said. There's a lot of ways you can combine them. Make sure that when you are combining them, you're not adding too many filters. Make sure you consider your trading style for the type of trade that you're doing. If you want to have a very highly selective trader, if you're a very risk averse trader, you may want to consider taking or adding multiple filters, adding 3 or 4. If you want more trade opportunities, you may want to consider just using combining 2 strategies together to make a single strategy. If you want lots and lots of trades, then you may want to not really add very many filters or very significant filters. What I mean by significant filters is saying I want a candlestick reversal paired with a trend line. Those are 2 pretty significant filters. But saying I want a divergence paired with a value level, that's not that significant. So make sure you realize what you're combining, the significance of those strategies. Make sure that they work together, that they complement each other, and then I would say just experiment with it a little bit. See which ones work out best. See how you like it the best. Which ones work better for your style. How do you know when to take profits? Look at this chart. The candle has a red tip. Are you talking about this here, where it just jumped, and it was significantly overvalued all the way up? You have a couple different ways you can take profits, depending on the strategy. You could either use a value target, which would be the overvalued level. You could use previous resistance, which would be those previous highs right here going across. You could have used a weakening of momentum, so once momentum started to die off right there, so when you got up here, it would have gotten you out. You could have used a break of the previous bar's low, so that would have gotten you out right there. There's lots of different options for when to get out of trades that you can use. It just depends on your style, the type of trade that you're in, the time frame you're trading on, whether or not you're long-term bullish or short-term bullish, what the longer-term charts are saying, such as your weeklies and your monthlies. So there's a whole lot of options. Having a value target is only one piece of the puzzle. You can use having a value target as a valid reason to exit, but if you're in it, if you're more of a swing trader, then you may not want to. It just depends. So we'll go into a lot more detail on when to exit trades in some of the upcoming workshops that we're going to be having. So that's kind of a topic for another day, but there's a whole lot of different ways you can keep you in a trade. You could use the MQ trend or the MQ regression to help you identify direction, staying as long as the trend or regression stays down. By the way, I wanted to show you this here as well. You see, this is the MQ trend, these red dots and these green dots. When MQ trend is red and MQ regression is red, then you have the okay to go short at overvalued. So there you would have been going short, and there you would have been going short. When MQ trend and MQ regression are not in agreement, for example, right here, this entire space here, you don't have the okay. That saves you from getting chopped up where this market just kept on going higher here, and when it kept on climbing there and went higher and higher and higher. That's how you do it. By the way, the gold head and shoulders did work out in the afternoon. Yes, I noticed that, Radha. Nice job. That was a good trade. So that's really all we had today. Essentially a pretty simple topic, just combining different strategies to be more selective, increase your odds, the probability of being successful with your trade. If there's any more questions, be happy to answer them. If you have any more questions that I don't answer, if you'd like to see some more videos or get any more information, feel free to visit valuecharts.com. If you want a free week trial for any of the trading rooms, whether that be Forex, futures, or options, you can go to valuecharts.com, click on the trading room icon on the left, select whatever trading room you want, and click the Get a Free Week button. If you would like a copy of any of the disclaimers, feel free to send an email into support@microquant.com, and we'll get those to you as soon as we can. So, is Jim still running the Futures Live Trading Room? No. Jim Allswagger is no longer running the Futures Trading Room. I am running the Futures Trading Room once again. So I'll be running that. We have pretty good. We've been doing pretty good over the past. I've been running it since last week again, and we've been doing extremely well. Sounds good, Clifford. I look forward to seeing you in it. So again, that's all that we have for today. I hope everybody enjoyed it. If there's no more questions, then we'll go ahead and conclude today's webinar. Have a great evening, everybody. See many of you bright and early in the trading room in the morning.